Welcome to The Explainer. Let's get right into this because we've got a lot to unpack today. We are looking at a huge, dramatic shift that just went down at the Federal Reserve, and it's absolutely going to impact your wallet, your portfolio, and your entire investment strategy moving forward. We're talking about the June 2026 Federal Open Market Committee meeting, the very first one under the leadership of the newly appointed Fed Chair, Kevin Warsh. And folks, the playbook has officially changed. You might actually be asking yourself that exact question after seeing the headlines and watching the bond market react over the last few days. I mean, a lot of people were caught totally off guard. So we're going to use the data straight from the Fed, alongside analysis from top economists, to unpack exactly what Kevin Warsh's first meeting means for everyday retail investors. We are cutting through all the noise and looking right at the facts. So the big headline number, right out of the gate, is that the Fed unanimously kept the target federal funds rate exactly where it was, 3.50% to 3.75%. This marks the fourth consecutive meeting where they've held rates steady since their last cut way back in December of 2025. Now, on the surface, a hold might sound like a non-event, right? Just maintaining the status quo. But you really have to look beneath the surface on this one. Because this wasn't just your ordinary run-of-the-mill pause. It was a firm, textbook hawkish hold. They kept rates unchanged, sure, but practically guaranteed future hikes to fight inflation. The Fed has completely dropped its prior easing bias. They totally erased the signal that rate cuts were coming and instead pivoted to a much more aggressive tone. Section 1, Hawkish Hold Explained. Why drop easing bias? When we dig into the Fed's own summary of economic projections from March compared to their brand new estimates in June, it brilliantly illustrates the problem. Back in March, the Fed projected core PCE inflation for 2026 to be 2.7%. Now, they've revised that all the way up to 3.3%. Meanwhile, their forecast for economic growth, real GDP, has actually been revised down from 2.4% to 2.2%. So the Fed is staring down a reality where inflation is running much hotter than expected, while economic growth is slowing down. So where is that sticky inflation actually coming from? Well, the Fed is currently fighting persistent price pressures stemming directly from a few really key drivers. We're seeing massive energy price spikes directly connected to the Iran war, we're dealing with renewed supply chain shocks, and we are still feeling the lingering impacts of tariffs. It's literally a perfect storm of supply-side issues pushing prices up, which makes the Fed's job of cooling down the economy incredibly difficult. Section 2. Decoding the dot plot. A divided Fed. Looking at the official June dot plot, the projections for 2026 have shifted noticeably higher compared to where they were just 3 months ago. The consensus is definitely cracking under the pressure of these economic challenges. Breaking those expectations down makes the picture incredibly clear. Out of the 18 officials who submitted projections, half of the committee, 9 officials, now expect to actually hike rates before the end of this year. And get this, 6 of those 9 even expect multiple hikes. 8 officials expect no change, and only a single official projects a rate cut. This is a massive shift from March when the median expectation was actually for a rate cut. The consensus has completely flipped. But wait, there's a pretty huge twist here. Did you catch it? I said 18 officials submitted projections, but there are 19 people on the committee. That missing dot belongs to the newly appointed chair, Kevin Warsh himself. He broke a long-standing tradition and intentionally opted out of submitting his own projection. He essentially just told the market, look, I'm not going to play this game of guessing where rates will be in 6 months. Section 3, the Warsh Era begins, a new playbook. Warsh is coming in and just aggressively trimming the fat from how the Fed communicates. Former Chair Jerome Powell's final policy statement was 314 words long, and it was absolutely packed with what we call forward guidance. You know, those little hints and clues about what the Fed might do next. Warsh's first statement, a lean, mean 132 words, cut by more than half. He completely removed the forward guidance. Warsh explicitly stated that forward guidance just isn't well suited to the current economic moment. He wants to give you the facts, plain and simple, without all the hand-holding. And he's not just tweaking press releases either. He's looking under the hood of the entire institution. During his press conference, he announced the launch of 5 new dedicated task forces. These groups are going to structurally review and overhaul how the Fed operates. They're looking at Fed communications, how to manage the massive balance sheet, the data sources they rely on, how they analyze productivity and jobs, and their overall inflation framework. Full-scale discussions on all these massive changes are expected by year-end. So, it really all boils down to this incredibly blunt, unambiguous pledge from Warsh's surprisingly short statement. The committee will deliver price stability. Period. Warsh told reporters that this is a vital message the Fed has missed for 5 years, and he fully intends to fix it. The central bank is prioritizing the inflation fight above all else, and they're doing it without giving the markets a roadmap.
Section 4. Retail impact. What it means for you.
Okay, so how does this actually hit your wallet? Let's break down the impact by asset class. For housing, Warsh straight up admitted that current policy is somewhat restrictive. Borrowing costs are going to remain high. Without relief from underlying inflation, the Fed isn't riding to the rescue of the mortgage market anytime soon. For equities, or stocks, you've got to get ready for a bumpy ride. Without the Fed providing that forward guidance, the market is going to react violently to raw data. Finally, for cash and fixed income, the higher for longer stance means you can continue to find really attractive higher yields on cash equivalents for the foreseeable future. The bottom line for us retail investors comes down to these key takeaways. First, rates are staying higher for longer and maybe even ticking up. Second, the era of the Fed's safety net, telegraphing its every move, is officially over. Warsh wants financial markets to do their own homework. Third, market reactions will be hyper-dependent on actual economic data releases, not Fed speeches. And finally, keep an eye on productivity. The Fed noted that productivity growth and capital investment remain strong, which is a major bright spot that could absolutely help offset some of this inflation down the line. Which brings us to the ultimate question for your financial strategy right now. With the Fed aggressively yanking away its communications safety net and putting the focus squarely back on fighting inflation, is your portfolio actually ready to handle the raw data? It is a whole new ballgame out there, folks. Thanks so much for joining me for this explainer, and I highly encourage you to go look at your own asset allocations through the lens of this brand new Warsh playbook. Catch you next time.